Hey everyone, welcome back to another episode of Fear-Free Passive Investing. Today, I've got my good friend and business partner and just all-around good dude, Brent Kawakami with me today, and we're going to do something a little bit different today. He's actually, we're going to flip the script, and he's actually going to be interviewing me about a few things here and there, and we're just going to see where it takes us.
Yeah, I'm taking over. Take it over.
Thanks for being here bright and early in the morning. Although
it's earlier for
wake up
you.
like
Yeah.
2 hours earlier. So
Yeah, I'm up early, but you're an hour behind me now. So you're the trucking along here. But we got plenty of
yeah,
coffee, so we're good.
lots of coffee and lots of things to talk about. So you, uh, gosh, you were like one of the first guests on the podcast, like almost a year and a half, 2 years ago or something.
It was that
And
best ever, right? Was that it? Was that the
yeah,
one we
oh
did?
yeah, right before that. So yeah,
Yeah.
so a little over a year ago, year and a half ago. Um, but the audio was just horrible, and I couldn't,
Because we
in
were
good
doing that
faith.
from a hotel lobby, right?
Yeah, the video is still on YouTube, but I can't bring myself to like publish the actual audio because it's so bad. But so we'll have you. We're gonna do this pretty regularly, so hopefully people will get to know you a little bit better. But for those who don't, maybe you could take a couple of seconds and explain who you are and what you
Yeah.
do.
Yeah, definitely. So, my name is Brent Kawakami. I'm with Think Multifamily. I'm an engineer. That's my background. I got into real estate investing on the side back in like 2011, 2012. So I was a full-time engineer back then, and started doing single family rentals in the Dallas area. We're based out of Dallas, Texas, and got rentals under my belt. And, like most people in our space figure out, you're like, oh, dang, this is going to take a while
Yep.
to scale anywhere. And so, I kind of always knew about apartments and multifamily investing. So I started investing passively around 2015 into other folks' deals. Started doing that every year. Wanted to get a little more active. Knew I needed to find a mentor. And inevitably, I met my partner and my mentor, and now actual business partner, Mark Kenny. Before he kind of blew up in the
Yeah.
in the way he did. Really loved, as you find with any partner, right? You do
So
business
good at
with
what
people.
they do, right?
Yeah, good at what they do, and then also the know, like, and trust, and anything. So hopped on with him, kind of grew, got more active on the general partner side. Have done syndicated lead sponsor, whatever you want to call it, deals, and then I ended up leaving my engineering job earlier this year. Great timing for me because I left. I left at the beginning of March. So I left a very secure job. So I was telling you this before we got on. So I was basically working two full-time jobs, right? My engineering career and then my real estate stuff. So I left the engineering career like the first week of March. And so I left a very secure job. And then, of course, we're recording in July of 2020, COVID hit. And shutdowns happen, but
Oh
but
man.
it's been great. I love it. So it's when you love what you do, as cliche as it sounds, it doesn't feel like work. So
Yeah, that's cool though. And that's where you and I met. We met through Mark because Mark is my mentor as well, and we kind of just clicked, and I helped you on one of your deals, and
yeah.
that kind of just started
Yep.
everything.
And now you're working on or you're trying to wrap up a deal right
Yeah.
now.
Yeah,
And I know.
so that was, I mean, just COVID, everything, like, and I should caveat this by saying, like, none of me or my family have ever had COVID, so we're in a really good spot, and it's hard to complain about that, right? When there's people dying, but yeah, it's made life a little harder.
Yeah. Let's dig into that. So, like you said, I'm gonna flip the
Yeah,
script on you. So, I mean, obviously, we can we can remove certain details and protect the
yeah.
protect the guilty, I guess, or whatever. But yeah. So maybe for your audience, what I know all the details, but what give us
Yeah.
kind of the background on the deal.
Yeah, so back in February, me and another partner, we were kind of just going back and forth trying to find deals in Little Rock, Arkansas, which I'm a big fan of Little Rock, Arkansas. And he found this and kind of sent it over, and I did some initial underwriting and he did some, and we just kind of went back and forth, and finally got to a point with a broker where he said, yeah, go ahead and submit the LOI and the letter of intent, if you don't know what that is. And then we actually got it under contract, which was awesome. And
we were driving in Denver, and
yeah,
Tim was on, we were in the car when he was talking to the broker getting the offer accepted.
yeah, we were literally in the car with you and a couple other people when we got the news that we got the deal, which was awesome. And that was back in February. And then we traveled to due diligence, and actually on the way home, I had a layover in Dallas, and that's where you and I met for lunch. And that's when you told me you were leaving your job. I was like, cool, nice. Brent's leaving his job. He's going to have all these deals now. And
yeah, and then COVID hit.
Yeah. So initially this deal, it's not dead. Like, to make a very long story short, it's not totally dead, but it's likely that something, it would be really cool if it closed, but I'm not counting on it.
Yeah. It's been a zombie. It's come back to life to life and died about 6 times, right?
I mean, honestly. And the funny thing is, usually if something happens like with the deal, at least in my experience, it's usually been something about the deal. Either you uncover something that changes the underwriting dramatically, or, something happens with the deal. This time the deal has just been churning along. It's a phenomenal deal.
It's a killer deal. A killer deal.
Yeah. Before, and actually, this is even funnier. Like, you and I know this, but the guy that you bought your deal with from Atlanta is the same seller as we're buying from now. So yeah. He knew that we could close the deal, and he's a pretty reasonable guy. He's really nice, and you got a screaming deal on your deal, or screaming price, I should say, on your deal.
Yeah, and I think that goes to like the being a good buyer and seller, right? Like, we transacted with this particular seller, and it was at the time it was like, man, this was the smoothest transaction ever, type of thing. And then so that carries over, and I would think that kind of helped on a Little Rock deal a bit, right?
Oh yeah, I mean he knew we could close. He knew this deal was kind of in our wheelhouse, and so we were underwriting it with a bridge loan, and a bridge loan is a little bit higher of an interest rate, although not really at that time. A little bit higher of an interest rate, but less restrictions on it than like a agency, government-backed, quasi government loan with Fannie or Freddie. So less restrictions, and it was through a servicer that we'd used before, and it worked out really well.
Yeah. And then the capital markets fell apart, right?
Yeah. Yeah. So they said they were still lending after COVID, but they essentially couldn't securitize a loan on the secondary market, meaning they were bunching up loans and selling them off. And the person that was going to, or the entity that was going to buy this basically lump of loans, backed out. And when they backed out, this lender they didn't have any liquidity. They didn't have any money to loan, or they had very little. And so we were basically told, sorry, we're done. And so after that, there was a mad scramble of like, and the timing could not have been worse, with like the shutdowns and the cases spiking. And this was back when, and I don't mean to make light of this, but this was back when we thought this was going to be a very serious thing.
Yeah.
And so we weren't, everybody was panicking. And
yeah. And then on the lender side, I think what made it difficult for you, obviously, so your lender basically we're sitting on the sidelines, but pretty much half the bridge lenders decided, hey, we're not lending, or they went on a business already, and the other half were like, okay, there's extra risk, we're raising spreads, so now
Mm-hmm.
At the time, I think bridge rates were like in the fives, maybe, that you're able to get. And now we're talking like
Yeah.
7 or 9%. So.
Well, on our way back when from due diligence, I was on my flight and we got a quote for 300 points over the 3-month LIBOR, which at that time was like 4.6%, which
Oh, wow.
that's
So
astounding.
you went from like a 5 to a 7 something, basically.
10.
Just 10. Oh, wow.
there was one bridge lender that said, yeah, we'll do that. No problem. 10%. And there was another one at 8%. And these were people that our mortgage broker had really good relationships with. So,
yeah.
I mean,
when your rate doubles overnight.
I mean, it was a good deal. And
Yeah.
we were honestly considering doing it and just refining out. But then that was like I said, right when we thought this was going to be really bad and everyone was going to lose their jobs. And so,
yeah,
hindsight's 2020, but we probably should have taken it and just kind of tried to refi out later. But, it is what it is. So,
yeah.
All the meanwhile, on the back end, the seller was kind of understandably, he didn't actually think we would be able to close this deal. We had about $150,000 that was hard risk capital. And about 50,000 of that was mine. And then it was split among 2 other people. That was hard. We weren't going back. And so we were obviously a little upset that we were going to lose this money.
Yeah, you're clinching for sure.
Yeah.
What's going on?
And eventually it came, like, we tried to go get every loan we could think of. We tried to I don't know. We were just trying to get really creative with it. And the seller was being awesome. He was really trying to work with us. Meanwhile, the whole deal was like continuing to churn along. It never skipped a beat. I mean, revenues continued to increase.
Yeah. Didn't collections increase during kind of the COVID period, right?
Yeah. And it's mainly due to there's a lot of healthcare jobs, and Little Rock didn't have quite the shutdown as some of the other areas. So a lot of stuff was still open. But it was just really interesting to see that deal continue to turn along. But anyway, behind the scenes, the seller didn't think we were actually going to close. So he went and he was on the time clock because he kind of had we think he had a 3-year bridge loan coming due in October. And so he needed to refi or sell essentially. And he was purchasing it through a fund. And he had to close the fund, or he was closing the fund. So he had to liquidate the asset. So he was on a bit of a time crunch too. And so what he didn't tell us was that he was actually applying for an agency loan, a Fannie Mae loan that was assumable. And so when all of this, we were still kind of just kicking the can down the road, waiting for lenders to open back up, he kind of presented us with this, hey, I went and got this amazing loan, 7-year variable rate loan. That was the worst part of it is that it wasn't a locked in rate, but it was a variable rate loan, very low interest rate, no interest only, which also was kind of a bummer, but the deal was so cash heavy that it really didn't matter a whole lot.
Yeah.
But again, something happened where when he went to do this, it appraised for almost almost $2 million more than what we were buying it for. So it appraised for a lot of money. which
we'll get into the story, but normally you'd be jumping up and down for that. Right?
Yeah. So it appraised for a ton of money and it allowed him to take a lot of cash out or essentially get the loan to where it would work.
Yeah. Now, did you guys look at agency debt? I'm assuming you did. Right.
Yeah. And we were essentially told that, okay. And so part of this property, part of the value add for us, quote, value add, is that it's being managed very poorly, very poorly. Expenses are very high. This particular management company is notorious for just terrible dealings.
Mm.
They're not good at their job. And so there was a little bit of crime on the property, nothing violent or nothing crazy like that. And it just didn't look sexy on paper.
Mm-hmm.
And so fast forward to us trying to apply for a loan, Fannie's looking at this saying, well, we've got all these other deals that are way better. We're just going to go with those. And
Yeah.
so they kind of kicked us to the back of the line and said, if and when we start lending regularly, you guys are in line.
Yeah.
We kind of just realized that we didn't have the right pull with Fannie. Like, we're not one of the big, huge buyers, and so we couldn't really play a trump card and get to the front of the line. Whereas the seller did. That's how he got this great loan, because it was a Fannie loan.
Mm-hmm. Gotcha. And then too, I mean, back to, we're talking about the debt markets were kind of crazy. I mean, this was when agencies were still uncertain. They were layering on all these additional reserves as well, right?
Oh yeah, that's a whole. I mean, we could get into the whole concessions
Yeah.
we made on the deal, but the deal was screaming. We negotiated him essentially carrying interest free, carrying I think it was 12 months interest reserves.
Mm.
So we had 12 months of payments that he was financing at 0% interest for us, which was awesome because we didn't have to go and raise that money.
Yeah.
He guaranteed revenue at a certain level for 6 months, which I think is really cool.
Yeah.
And a few other small things here and there, but like, it just kept making the deal better and better and better.
Yeah. Well, and then like you said
matter.
too, I mean, both sides were, incentivized or trying to get the deal done. Right. So that
he
helped.
wanted to sell. And when it came to, like, he basically didn't think we would be able to raise the money during the pandemic.
Mm-hmm.
And when it came to light that, hey, we've got, close to $4 million committed and some of it also sitting in the bank, he's like, oh, okay, well, here's this option to assume the loan.
Yeah. Gotcha.
So fast forward to like a month ago, where we thought we were good to go, assuming a loan, everything's going well. Now comes a snafu with his application.
Mm-hmm.
He didn't, and I don't even know if we should get into it since it's not even settled, but basically it's a he said, she said between the lender, not Fannie, but the lender, Arbor, and the seller. Basically, like, there's an argument somewhere along the line of what was checked and what was not checked on an application. And it gets back to that appraisal. So the whole point of Fannie Mae loans, or, GSEs, government sponsored entities, where they will sponsor some of these things, they will back some of these things, so long as you are providing housing for people, right? And so they're not in the business to make money, they're in the business to provide housing. That's why you have low interest rates or favorable terms. But they have like significant prepayment penalties, and because they don't want you using their loans to flip properties. And it turns out like that was kind of the tipping point for this lender, that they didn't want to give the impression to Fannie Mae that they were appraising deals higher than what they were worth, just to get better proceeds, only to have someone assume the loan for a much lower price. And so on the surface, you'd think like, oh, there's so much equity in this deal because it's valued so high. Everybody should be happy about that. But in reality, they were less concerned about that, more concerned with the optics of it.
Gotcha.
So, and we're stuck at our price because we can't afford to pay more, because our
investor
returns, and then it is what it is. It's valued very high on a trailing three months revenue, but on a T12, it's not that, it's valued normally. So it makes sense, but
so a little snafu.
So now we're in negotiations to try and come up with a solution that would make everybody happy, and
to be determined.
Hopefully we can do a wrap-up episode when this closes and we can talk about that. But
this will be a great war story, you know what I mean? So
I- it's been tough, but a lot of people have lost a lot of money during COVID, and I'm not one of them. And right now,
Yeah.
as of
Yeah.
as
It
of
could be worse.
July,
Could
yeah,
be worse, right?
yeah,
So,
and
yeah.
I'm happy with where we're at.
Yeah. No, that's good. So I'm curious, obviously to be determined, how has raising capital been through this
Oh
period,
yeah.
with the deal? Because, you know, like you said, I mean, unprecedented time, right?
Hmm.
You have what has been the investor sentiment? How's the capital raise gone? Like,
Yeah.
what has that been like?
Yeah, I think this deal is probably like stressed me more than any other deal, only because like it was just a constant roller coaster of emotions, and
Yeah.
you would be down in a deep valley talking about like how you how they just backed out and you're going to lose all your earnest money, to a very high peak, which is like raising capital. We had, and I don't want to say no problem, and I don't want to jinx it because
Yeah.
we aren't actually closed, but we had basically no problem raising the money. It was
Hmm.
crazy the amount of demand that we had. And of course, it worked out that it was the right deal in the right location, and it had all the things a lot of people were looking for.
Yeah.
Not every deal does, but it was also the benefit that it was like one of the few deals that was actually going on during all this too,
Yeah.
not just in the think multifamily group, but
Yeah, just in
it,
general.
it
I
just
mean,
in general. I
you have a lot of syndicators, operators that are sitting on the sidelines, right? And
Yeah,
wait see, which good reason. I don't blame people, but um
yeah, I think everybody has their theories of where they're at right now, but investors that were looking for to place money either because they were sick of the stock market, which a couple of months ago was up and down, up and down,
yeah,
up and down.
yeah, or if you were in, was it late March when it dropped like 30%,
Yeah,
whatever it was.
yeah, that's about when we started raising money too. So
Yeah.
yeah, I mean, within a week or 2 weeks, we had all of our money basically committed, um, and then you know, uh, we basically put it on hold with all this stuff going on. So we don't actually have all the money sitting in the bank. We've kind of told people, hey, hold off, hold on the sidelines.
Yeah.
But that's been like the nicest part of all this, which is kind of a surprise.
Yeah, normally your capital raise is one of the stressful parts. So
Yeah.
what what was sort of the conversations you were having? Like what was kind of the feelings you were hearing from investors as far as, sentiment,
Yeah, it was interesting. A lot of people really they kind of almost made the point for you. Like
Hmm.
we of course in the back of our head thought like, this is a temporary problem, COVID being the temporary problem. It's probably not going to be a thing in a few years. It'll be something we look back on. It probably won't be lasting. Um, Fundamentals like commercial real estate, valuations, cash flow, things like that are long-term proven strategies. And so we were very bullish on, especially one with this much meat on the bone.
Yeah.
Um, but I think in a lot of my conversations with my investors anyway, a lot of it came down to like, why do you like the deal? It wasn't
Yeah.
necessarily about the economy. It was about the deal. And once we explained the fundamentals of the deal, it was a very easy transition because, and I think this is kind of interesting too, for some reason, and I can't really come to a point on
Hmm.
this, coronavirus has kind of like become this politicized thing. And so if you
Oh
fall
yeah.
on
When
one side of the aisle or the other, you have drastically different opinions on it. And the
yeah.
people that are thinking like it's not the end of the world, those were people that were jumping at this opportunity. The people that were terrified or with a caveat that they're thinking better deals are down the road, they
Hmm.
were holding off.
Yeah, there's sort of that, hey, there's gonna be blood in the streets, and
Yeah.
that's what I'm waiting for type of thing.
Mm-hmm. Yep. I heard of one syndicator say she was going to pick up deals like 20 to 30% off. And it never happened to
Yeah.
me. I never saw those deals, but
Yeah, I'm wondering if we're probably, so, time will tell, right? And unfortunately, like
yeah.
you said with politicized things, November is probably when this will probably hit
Yeah,
ahead.
it'll be
But
done after that.
but yeah, I mean, at least from what a lot of people smarter than I am and more experienced. I mean, it seems like you're not going to see that 20-30% blood in the streets thing. If you're waiting for that, you know, good luck.
Yeah. I mean, given some sort of, excuse me, some sort of like other event, like a partnering cataclysmic event, I just don't see it. Like, well, you underwrite deals every single day, probably.
Yeah. Yeah.
I haven't seen any price decrease. Maybe a little bit with like accounting for interest reserves.
Yeah.
But the thing is, like, if you can get around that by saying, "Hey, seller, you hold that," you're right back up to market pricing.
Yeah, I think, we're constantly underwriting deals now. And, what was nice during the COVID period is everyone's at home and, things kind of slowed down a bit. So, I mean, I was able to have I've never had hour-long conversations with brokers before. And I've had a few of those, so,
That's awesome.
so I think the general, going through that whole period, obviously there was a wait and see.
Mm-hmm.
And then everybody would be like, okay, let's see what this month's collections look like. Let's see what this next month's collections look like. And, a lot of it's probably the helicopter and stimulus money that's, we put out. But for the most part, across the multifamily industry, collections have remained fairly stable. Nothing fell off a cliff necessarily. The people who are in trouble were probably already kind of in trouble going into COVID. And, that was kind of the nail in the coffin type of thing. And so, the deals that we're trading, or at least we're being a lot more off market stuff, right? So listings just kind of stopped and things are being floated off market. But as a general statement, I mean, from a pricing standpoint, I mean, we're still kind of in this pricing discovery mode, but I mean, you are not getting anything more than even a 10% discount. I mean, maybe if you were good and lucky, 5 to 8%, as the quote unquote COVID discount. And then, at least, and again, we don't know what's going to happen between now and November, but I mean, even now there's a lot more listings coming out. I think a lot of people feel more comfortable in the asset class. And so it feels like things are starting to pick up now a bit. Again, we don't, who the heck knows, but the 20-30% discount, at least for the near term, doesn't look like it's going to happen. Now, if these extended unemployment and stimulus things run out at the end of July, we'll see how things go. But, this is not, it doesn't seem like, at least for real estate, this is 2008 again, you know what I mean? And that was a real estate caused crash, right? So,
right. Yeah, that makes sense. I think if we were to have seen it, we would have seen it earlier, unless some sort of like disastrous second wave, or I saw like China now has a case of bubonic plague, like something like that happens, maybe.
I didn't hear that one. I heard about the murder hornets at one point. So.
Murder hornets, and China has a confirmed case of bubonic plague now, and whatever. At the end of the day, I think if you're a seller and your deal is performing well, which a lot of them are right now, and you don't have a reason to sell, like if you have the ability to refi into a different loan or a longer term loan, which almost everybody does, and you don't need to sell, why would you take a 20% cut just to be out of that deal? Like,
you're looking at your financial. So, we've been having BOVs done on properties, that we own now. For those in the audience, so it's broker opinion of value. It's basically, having a broker go, do the comps, run the analysis. If they were to take it to market, what realistically could you expect to get potentially? And the reality is, it's like you said, if you're a seller and your collections have remained stable, why would you want to take a 20% haircut? You're not going to. You're just going to hold it. Unless you're taking some other kind of brain damage or, I have other needs.
Something else.
Yeah.
But the multifamily came out of this is very close to being, I can only think of like industrial that did better during all this because of Amazon. But
I've heard self-storage doing really well now too, actually. Yeah,
But if you
but
think about it, you're like one of the safest asset classes
yeah.
ever, and your money's tied up in that. Why would you go and take a set? What would you do with that money?
Yeah, if you were, like you said, I mean, you probably had a lot of investors who had a lot of stock market exposure. So,
Mm-hmm.
like you said, they took a huge punch to the gut in March, and it's been a roller coaster ever since then.
Yeah.
If you were in retail or office space or
Short-term
hotel
rentals.
hospitality, short-term rentals, man, you got destroyed. We
Yeah.
know a guy here who's really heavy in hospitality, and it was like bad. I mean,
Yeah.
occupancies are like 14%, which is insane. So it's
Yeah.
so like you said, it's sort of a, knock on wood, you feel good about the thesis of,
Yeah.
hey, people need a roof over their head.
Exactly. And I think long term that deal is going to do very well. Whether we own it or not is another question.
Well, we're gonna think happy vibes, man. So,
Yeah.
we're maybe when we do this, so we're gonna do this every month and just to
Yeah.
catch up and chat. Maybe when we talk next time, it'll be, hey, this sucker closed,
Yeah.
or we at least see the finish line.
Yeah. Well, and it's not we're not slowing down. We've got
Yeah.
other deals in the pipeline, but this one is just like so nice. It's so good. There's so much meat on the bone.
It's a great deal. It's a great
There's
deal. So,
always another good deal. So
yeah.
it's kind of what I tell passive investors is like, don't feel like you're forced into jumping into something. There's always going to be another deal.
Yep. Yep. Definitely. So, no, awesome, man. That's good.
Cool.
Good hearing.
It was
Obviously
nice to be on the other side of this.
No, it's cool. This is fun. I think this will be good stuff for us to continue doing.
Yeah, I think moving forward, you and I will just have conversations about other stuff. Because I mean, you sometimes you host the Think Multifamily podcast, which is really good, and we'll leave a link to that down in the description. But you have a lot more exposure to good ideas and experts and stuff. So it'll be a good complementary person to have regularly.
Awesome, man. Awesome. Well, thanks for having me on so early in the morning for you.
Yeah, I know. All right. See ya.
All right. Have a good one.